Hello and welcome to a CMS Forex Daily Market Recap. I'm your fundamental market analyst, Nick Nassad. Today is Wednesday, May 12, 2010. Let's start today's broadcast by focusing on the pound-dollar pair, which we saw rallied overnight when it hit a resistance from earlier in the week around 1.5045. Since then, which was during the European session, we saw the pair slide, giving up its earlier gains and hitting a new low for the day towards the end of the trading session. Now, the UK pound weakened today as investors focused on longer-term fiscal issues, even as the new coalition government announced belt-tightening measures to shore up a sagging UK economy. In a document setting out agreed policies, the government said that deficit reduction and continuing to ensure economic recovery is the most urgent issues facing Britain. The government confirmed it will cut spending by £6 billion this year and announced some proposed tax increases. Also weighing on the pound was that Bank of England's Monetary Policy Committee, which signaled that it would not tighten policy for at least the next year, according to its inflation report. So, following the sharp slide in the pair last week, now we seem to be consolidating within this range with our new resistance now holding at 1.5040, which was also our 200 period moving average in the 1 hour time frame. On the downside, we'd look to our support from this week at around 1.4710 or 20 in order to find our next support level. As you can see, today we moved below our other moving averages, our 100 period and our 50 period moving average, so that could be a bearish development for the pair. Taking a look at the euro-dollar pair, we saw the euro slide today after it rallied in overnight trading on some positive data. However, there just remain too many lingering issues of eurozone sovereign debt, which eclipsed the slightly better than expected economic growth data we saw, and we will examine it in a moment. The fear here is that the stringent spending cuts needed for stressed Eurozone countries and in the UK will mean that we will have weaker growth going forward. So while those economies may stagnate, other major economies, especially in the US and in commodity-backed economies like Australia and Canada, will continue to improve, which should outpace, with their currencies outpacing that of the Eurozone. So the budget cutting that will be necessary to get the spiraling Eurozone country deficits back under control will dent the Eurozone's growth prospects, and the likelihood that the ECB will raise key interest rates anytime soon seems remote. Those two factors make the euro unattractive currently. Let's take a look at our data from the Eurozone. We saw that the Eurozone economy grew 0.2% in the first quarter, according to its flash or advanced estimate. That was better than expected, a 0.1% rise, and better than the flat reading we had seen in the fourth quarter. A bigger than expected increase in exports helped to overcome some sluggish consumer spending. The core countries of the Eurozone, Germany and France, saw slightly positive growth, with Germany increasing 0.2% and France up 0.1%, that was lower than it was in the fourth quarter. Both Italy and Spain moved from negative growth in the fourth quarter to positive growth in the first quarter, though Spain's 0.1% was just barely growth. Portugal, which had come under intense pressure as a result of its debt and budget deficits, saw its economy grow 1%, which was actually the best performance in the Eurozone, while Greece, on the other hand, saw another dismal quarter, following up its 0.8% slide in the fourth quarter by shrinking the same amount in the first quarter of 2010. The big question now is how the recent financial turmoil will impact the region's recovery going forward. A second report from the Eurozone showed industrial production surging 1.3% in March, slightly higher than expectations and a big increase over the 0.7% we saw in February. On the year, production climbed 6.9%. Looking at the data closely, we see some very encouraging signs, though this data now is dated in that it's for the March period, and now we are all the way in May, so this doesn't reflect any of the more recent turmoil in the Eurozone. Still, looking at the data, we see improvement in production came from a big jump in capital goods spending, which rose 1.5% compared to February 0.6%, and both durable and non-durable consumer goods were higher than they were in the February period. So while this was an encouraging report, it will take some time for the data to catch up to current events, as again, we're only looking at the end of the first quarter here. Sticking to the theme of fundamentals, let's take a look at US data from today. The US trade deficit grew to a 15-month high in March, as growth in both exports and imports did rise, which suggests that the economic recovery is gaining steam. We saw exports rise 3.2% to a total of $147.9 billion, while imports rose 3.1% to $188.3 billion. The trade balance deficit widened, even though exports rose by a higher amount than imports, because imports are actually a larger figure overall. So a smaller percentage rise could be a bigger nominal rise. Overall, we could take away that this was a positive report for the U.S. and global growth outlook. We also saw the U post its federal budget balance for the month of April, and we saw a shortfall of $82.7 billion, which was much larger than expected, and is a large bigger deficit than in April 2009 when we saw a deficit of $20.9 billion. The deficit was worse than expected because some May payments were moved up to April since May 1st fell on a Saturday, so this was a bit of a technical issue, but it did distort the data. These payments included military active duty pay, veterans benefits, supplemental security income payments, and Medicare payments to health maintenance organizations. Since those payments will now not be included in May, their absence will improve the May budget numbers. Stocks were higher in the U.S., but that didn't really affect currency markets, or at least the dollar-yen pair, which is usually quite sensitive to what's going on in U.S. equity markets. We had the Dow Jones Index rise 150 points, and the S&P 500 was up 1.37. While the dollar-yen did rise somewhat in favor of the greenback, we stayed within our range from yesterday, and we could see that this pair is consolidating as we have decreased volatility following our very sharp moves in last week. We had another piece of fundamental news worth reporting, and that was Canada's trade balance for the month of March, and we saw an unexpectedly small surplus of 0.3 billion Canadian dollars. Forecasts had called for a 1.6 billion surplus. Exports were down 0.7%, while imports rose 2%. Looking at the US dollar-Canadian dollar pair, we see consolidation here as well, as we moved very sideways in today's trading, and we stayed within the range we had seen yesterday. Yesterday we did move below this 200 period moving average in the 1 hour time frame, and today we used the 50 period moving average as resistance. Our support is now at the 1.0150 level. Now the Canadian dollar, or at least the Canadian economy, is in pretty good shape, and the central banks does look set to increase interest rates pretty soon, perhaps in June or July. Also, the financial system in Canada is usually much safer with lower leverage, and it has escaped the recent turmoil, so the finances of the country look very good. In our last market highlight, we take a look at gold. Gold is clearly king right now, moving to a new record high of 1,248 in today's session, as gold is the tangible currency of last resort. Many investors fear that Europe's rescue package of nearly $1 trillion will bring about inflation by injecting liquidity into the markets. Investors' concerns also are not going to dissipate in the medium term, as the underlying problems with the Eurozone countries still remains, though it seems that they have bought themselves some time with the rescue package. Now, gold has been rising rather sharply over the past month, since March 25th, and the inflow into gold ETFs and other trading vehicles have risen significantly. So we'll see if perhaps there could be some pullback to these recent moves, so in which case, if we retest one of our moving averages, we'll see if we have another chance for gold bulls to buy on a dip, which would extend the rally. So that'll do it for today's highlights. Let's take a look at our upcoming fundamental docket. Tonight in New Zealand, we get data on manufacturing, from the UK on consumer confidence, from Japan on bank lending and money supply, and from Australia we get its employment change as well as the unemployment rate. Overnight, we're going to have bank holidays in Switzerland, France, and Germany, so that could impact liquidity during the European session. From the UK, we get trade balance data as well as a measure of housing prices. Tomorrow, the docket is rather light in the North America session, as we get U.S. import prices as well as the weekly jobless claims. And that concludes today's broadcast. For news, videos, and analysis, please visit our site cmsfx.com. I want to thank you for watching and wish you good trading.